August is here and the ETF market is buzzing. New funds, new themes, and big shifts in investor behavior. Hello, everyone. I'm Stephanie Stanton. This is First Look ETF. And coming up on today's show, cycle-aware investing is built to focus on what's working right now in the U.S. equity cycle. So here's the real question. How might your performance returns be if your equity exposure actually shifted with the cycle instead of fighting it? Well, stick around for the answer. And nicotine companies are changing fast, shifting toward products with lower health risks and new business models. So how do you invest in an industry that is right in the middle of this massive change? We're going to break it all down for you and spotlight an ETF that is positioned squarely in this trend. But first, before we go any further, we want to welcome Ethan Hertzfeld with the New York Stock Exchange. Ethan, thank you so much for joining us.
Stephanie, thanks for having me again, as always.
All right, let's begin with the latest update on ETF launch activity. How are things looking?
Launch activity continues to be incredibly strong through the month of July and into August here. Year to date through July, we've seen almost 900 new ETFs launch, bringing in almost $100 billion in new AUM, as ETF flows have gotten over 1.2 trillion, pushing really close to 1.3 trillion on the year. Active ETFs have brought in almost 40% of new flows, which is an incredible number, and make up about 80% of all new launches we've seen year to date. Those numbers haven't changed.
And which structural trends in the ETF industry, active ETF adoption, or thematic ETF consolidation are shaping the competitive landscape this year?
As far as trends we've seen over the first half of the year, I think we've seen the compression of fees continue. A lot of people competing on that front to provide the lowest cost investments for their clients, and around the ETF space continues to be a driver. Active management continues, and we've seen a lot of movement in new and innovative products as well, some of which we're going to get the chance to talk about today.
And of course, as we always do, we have a fabulous guest lineup. So what are you looking forward to most on today's show?
We certainly have an exciting lineup of guests joining us today for the August episode of First Look. Really excited what they have to share, the new products that they're bringing to market, and the new and innovative strategies.
All right, Ethan, thank you so much for the update. Keep up the great work. We will see you soon.
Thanks for having me again, as always.
And just a quick reminder to watch First Look ETF on Apple TV, Amazon Fire TV, and Roku. Also, we simulcast First Look ETF on iTunes and Spotify, so don't miss it. Nicotine companies are shifting toward products with lower health risks and completely new business models. So how do you invest in an industry that's right in the middle of this massive shift? Well, for the answer, let's welcome Pieter Vorster, CEO, Hexis Capital Management. Hi, Pieter. It's great to see you.
Thank you, Steph. Great to be here.
So first of all, congratulations on your latest ETF launch, the Hexis Active Nicotine Engagement ETF, and your ticker there is NICO, NICO. Let's begin with the core investment philosophy behind NICO and why Hexis decided that now is the right time for an actively managed nicotine transition ETF.
The core philosophy behind NICO is engagement over exclusion. And it starts with a simple observation, which you already mentioned, which is that the global nicotine industry is undergoing the biggest transformation in its history, away from combustible cigarettes towards reduced risk products, such as heated tobacco, nicotine pouches, and vaping products. What we see today is that most investors deal with this industry in one or two ways. They own it passively through index trackers, or they exclude it altogether. And we believe both of these groups are giving something up. And NICO takes a third path, and that path is we invest actively across the nicotine ecosystem, and we engage directly with companies to encourage them to accelerate the transition away from cigarettes. Now, why now? Because this industry transformation has reached a critical tipping point. We've seen Philip Morris generate over 40% now of their revenues from smoke-free products. In Japan, over 50% of nicotine-related volumes come from smoke-free products. And in the US, pouches are the represent the fastest growing category within the nicotine space. Now, the companies are moving at very different speeds, though, within an environment where we're seeing rapid changes in regulation and technology. And this is exactly the kind of environment where we feel that disciplined, active management combined with engagement can add significant value.
Okay, so walk us through the Hexis nicotine transition score. What inputs matter most? And then how does the score actually influence Nico's portfolio construction?
The transition score, the Hexis Nicotine Transition Score, HNTS as we call it, is an independently verified proprietary framework that we use to measure how credibly each company is executing its transition. And the key word here is executing. The objective is not to reward ambition, but it is to assess delivery, but also potential. It's built on 27 indicators across 3 pillars. The first one being, where is the business today? For example, what percentage of their revenues come from these reduced risk products? But importantly, the second bit is growth potential. And here we assess how the company is allocating its resources and whether that is conducive to an acceleration in transition. And then finally, but certainly not least, is governance and sustainability. Is management genuinely committed, and is accountability aligned to this transition? Around a fifth of the score is AI supported. There we look specifically at signals like patent filings, which is humanly impossible to analyze that number of filings, hiring trends, and also management sentiments towards this category. But AI really only supports fundamental research. It never replaces it. Now, on portfolio construction and how it feeds in, we are bottom-up valuation-driven investors. We have discounted cash flow models for every company, and the HNTS systematically informs the long-term growth rates we assume for these companies. So companies with higher scores can earn greater weightings, provided the valuation supports that. An important factor to mention also is that every holding must be generating revenue from reduced risk products and also have a strategy to grow it. And then finally, the scores doubles as our engagement roadmap, where companies score poorly relative to their peers. This tells us really where to engage with management and to raise these points with management.
And Pieter, quickly, just a few minutes left here. How do you see investors potentially using Nico inside a diversified portfolio?
Well, I think, as you say, most investors already own broad equity exposure, for example, through index funds, which means many of them already own these companies passively, but without engagement, while others have excluded it completely and given up any influence over it. So we see Nico as a targeted holding that complements core exposure in a few ways. For long-term investors, it provides focused access to a global cash-generative industry in transformation. It offers diversification. This is a sector that has historically produced very attractive dividends. And combined with that, it behaves very differently from the overall market. And for those investors who've excluded themselves from it on principle, it is a way back in, but a way back in with a voice, where engagement over exclusion applies. So it is complementary to core, and it gives investors an opportunity to participate in one of the biggest industry transitions of our time.
All right, we are going to leave it right there. Pieter Vorster coming to us from the UK, all the way from London. Pieter, thank you so much. It's great to have you today on First Look ETF.
Thank you very much, Steph.
Variant Perception has spent years developing tools to identify where we are in the market cycle: expansion, slowdown, contraction, or recovery. And VPX is an ETF solution that brings that research directly into an investable strategy. Well, here to tell us more is Tian Yang, CIO and fund manager of the VPX ETF. Tian, thank you so much for joining us.
Thanks for having me.
So the Variant Perception Cycle Aware U.S. Equity ETF, and your ticker is VPX. It's your firm's first ETF launch. So first of all, congratulations. VPX is built around Variant Perception's Cycle Aware framework. So with that being said, where do you believe we are in the current market cycle today? And then how is that shaping your current positioning?
Our lead indicators show that the broader macro environment today is very risk-on, keeping us fully invested in equities. However, under the hood, we are seeing some signs that you typically see more towards the later part of the cycle. So going forwards, we would anticipate an equity regime marked by extreme month-to-month intra-market shifts and rapid sector rotations. So this is a kind of environment where you don't really want a fixed, static, rigid factor exposure. And for us, we can use the tax-efficient rebalancing mechanisms that ETFs offer to adjust portfolios as we go. So for example, in late May, our models were signaling that the tech rally had got a bit overextended, so we started dialing down the risk there, rotated into traditional value. And now, after a pretty brutal July, we actually started to build back up our tech and semi exposures as well. So as of today, our main overweights are energy, financials, and semis, and our biggest underweights are consumer and healthcare.
Okay, so, then on that note, which macro indicators matter most in your cycle model? And then how do those signals translate into actual portfolio shifts?
Yeah, so we actually try to blend a lot of different macro indicators together. So in terms of the top-down business cycle models, we look at leading indicators of growth, inflation, policy, and liquidity. So these four are the main components that's driven our institutional research business for the past 15 years. And ultimately, we feed them through a lot of decision trees to understand the overall macro risk outlook. As I say, it's pretty risk-on right now. We then further combine this with industry capital cycle data, where we try to understand which are the industries that have seen overinvestment or underinvestment, and in turn we'll look to either overweight or underweight those sectors as well. So ultimately how that translates into a portfolio is we will add a final layer of screening for quality and crowding to create a final portfolio of more than 100 US large cap equities. No single position could be more than 5%. And ultimately, it's an expression of both the business cycle, the longer term capital cycle, and also stock-specific crowding and quality factors.
So if an investor already owns broad U.S. equity exposure, what role does VPX then play inside of a diversified portfolio?
Yeah, so we think of VPX as your kind of active cycle-aware complement to your traditional core equity allocations. We obviously understand investors have relied on market cap weighted benchmark ETFs like the S&P, and it's worked really well for the past decade. However, today, these broader benchmarks clearly have very extreme concentration. The top 10 names make up almost 40% of the index. So, from our point of view, that's not probably the ideal weighting you want as a static factor going forward. But equally, it could potentially be a bit lazy to just go, okay, why don't we just equal weight everything and hold 1% of 0.5% in everything. So from our point of view, you want to weight your portfolio based on your forecast expected returns over the cycle. And that's exactly what VPX does. So we think of VPX as, for example, you can put a 10% sleeve in VPX, keep a 90% sleeve in your SPY or VTI. This only marginally raises your blended expense ratio, but you get exposure to a product that, since launch, we've actually generated about almost 115% upside capture for 95% downside capture. So I think that, obviously, past performance not predictive future, but I think that's a nice complement to traditional core allocations.
Yeah, absolutely. Sounds like you are on the right track with numbers like that. Tian, thank you so much for dropping by here on First Look ETF. It has been a pleasure to have you.
Thanks for having me.
And that wraps up this edition of First Look ETF. If you enjoyed the episode, please let us know in the comments section and hit that like button. Want to give a big thanks to all of our guests, including Ethan Hertzfeld and the team at the New York Stock Exchange. For more ETF insights, visit etfcentral.com. I'm Stephanie Stanton with ETFguide. Thank you so much for watching. We'll see you next time.